Hey everyone, and welcome back for another deep dive. Today we're tackling a topic that's generating a lot of buzz out there. The world of private markets going mainstream. If you've ever wondered what exactly private markets are and how they're making their way from Wall Street to Main Street, well, you're in the right place.
It really is fascinating to see this shift happening, right? We're talking about a massive change in the financial landscape here. Private markets are currently managing around $11 trillion in assets. To put that into perspective, that's more than double the GDP of Japan.
Wow, that's a huge number. So for those who might not be familiar, could you give us a quick rundown of what private markets actually are?
Absolutely. In the simplest terms, private markets refer to investments that are not publicly traded on stock exchanges. So this includes things like private equity, where firms invest in and often acquire entire companies. Private debt, which involves lending money to companies or projects outside of traditional bank loans. And of course, real estate, which covers everything from commercial properties to residential development. Okay, so these are investments that used to be exclusive to big players like pension funds and endowments, but now they're becoming more accessible to individual investors. What's driving that change?
That's right. One key factor has been the JOBS Act of 2012 in the U.S. This act loosened regulations and opened the door for things like equity crowdfunding. This allows individuals to invest directly in startups and private companies online, much like Kickstarter, but with actual ownership stakes. We're also seeing a surge in demand from retail investors, particularly in the Asia-Pacific region, who are eager to tap into these potentially higher return opportunities.
So it's a combination of regulatory changes and growing investor appetite. But there's got to be more to this surge in popularity, right? What makes private markets so appealing in the current financial landscape?
Well, there's a convergence of factors at play here. One major driver is the search for higher yields. With interest rates on traditional investments like bonds remaining relatively low, institutional investors are turning to private markets in hopes of generating better returns. For example, data shows that private equity buyouts have outperformed the public stock market, delivering an average annual return of 10% over the past 2 decades, compared to 7% for the S&P 500.
So it's about seeking those juicier returns, which makes sense in a low interest rate environment. But isn't it also about diversifying, spreading your risk beyond just stocks and bonds?
Absolutely. Investors are increasingly recognizing the importance of diversifying their portfolios beyond public markets. Private markets offer a way to do this, potentially reducing overall portfolio volatility and making them more resilient to market downturns.
That makes sense. It's like the old adage, don't put all your eggs in one basket. But there's another interesting aspect to the shift, isn't there? Something about the changing nature of businesses themselves.
You're spot on. The rise of businesses built on intangible assets, things like software, data, intellectual property, is another key driver. These companies often stay private longer because private markets are well suited to fund their growth. They require patient capital and a deeper understanding of their business models, which is something private market investors specialize in.
So it's like a perfect storm. You've got investors seeking higher returns and diversification, and you've got this new breed of company that thrives in the private market environment. It's fascinating to see how these forces are reshaping the financial landscape. But let's be realistic. It can't all be sunshine and rainbows, right? What are some of the risks and challenges associated with private market investing?
That's a crucial question. While private markets offer exciting potential, it's essential to understand the risks involved. One of the most significant is illiquidity. Unlike publicly traded stocks, which you can buy or sell almost instantly, private investments can be difficult to exit quickly. You might be locked in for several years, which can be problematic if you suddenly need access to your funds.
So if an unexpected financial need arises, having your money tied up in private markets could be a real headache.
Exactly. And illiquidity also makes it harder to determine the true value of your investment, since there's no constant market pricing like you have with public stocks. This lack of transparency can be a concern for some investors.
That makes sense. So illiquidity and transparency are two key challenges. What about volatility? Aren't private markets known for being a bit of a roller coaster ride compared to the relative stability of, say, bonds?
That's true. Private markets can be more volatile, partly due to the frequent use of leverage. Leverage, in simple terms, is using borrowed money to amplify potential returns. While this can magnify gains, it also magnifies losses if the investment doesn't perform as expected.
Ah, leverage, the double-edged sword of the investment world. It can supercharge returns, but also amplify risk. So investors really need to understand how leverage is being used and what that means for their potential gains and losses.
Precisely. And different types of leverage come with different risks. For example, in private equity, Firms often use debt financing to acquire companies. This debt comes with covenants, which are specific conditions that the company must meet. And if they fail to do so, it could trigger a cascade of problems.
That adds another layer of complexity for investors to consider. We've talked about illiquidity, transparency, and volatility, all of which are important factors. But there's also the growing emphasis on environmental, social, and governance ESG factors. How are those considerations playing into private market investments?
ESG is becoming increasingly important in private markets. And for good reason. Investors recognizing that factors like climate change, social responsibility, and corporate governance can significantly impact a company's long-term sustainability and financial performance.
So it's not just about making money, it's about making money responsibly and sustainably.
Exactly. Investors are starting to demand more transparency from private companies about their ESG practices
Yeah.
and are factoring these considerations into their investment decisions. We're seeing a shift towards integrating ESG analysis into due diligence processes, and some funds are even specifically targeting companies with strong ESG profiles.
Okay, so we've covered a lot of ground here. We've talked about what private markets are, why they're gaining popularity, and some of the key risks involved. But what does this all mean for the future? Where are private markets headed in this ever-evolving financial landscape?
Well, despite the challenges we've discussed, the future of private markets remains bright. They're expected to continue growing. But it's not going to be a smooth ride. There are some economic headwinds on the horizon, like rising interest rates and geopolitical uncertainty. That could create a more challenging environment for investors.
That's right. Navigating these choppy waters will require careful consideration and a more discerning approach to investment selection. I think we'll see a widening gap between top-performing and underperforming investments in the private markets. So it's not just about picking the right asset class like private equity versus real estate, but about identifying the most skilled and experienced managers within those categories.
Precisely. Thorough due diligence is paramount. You need to carefully assess the track record, investment strategy, and expertise of the fund managers you're entrusting your capital to. Look for managers with a proven ability to navigate economic cycles, adapt to changing market conditions, and generate consistent returns.
So it's about looking beyond the hype
Yeah.
and really understanding the people behind the investments. That makes a lot of sense. But let's bring this back to our listener. We've talked about these macro trends shaping the world of private markets, but how does this impact individuals like you and me? Are these opportunities truly accessible, or is it still primarily a game for the ultra-wealthy?
That's a great question. And the answer is increasingly yes. Private markets are becoming more accessible to individual investors. As we mentioned earlier, platforms like equity crowdfunding and online lenders are breaking down barriers to entry, allowing individuals to participate in deals that were previously only available to large institutions.
So regular folks can get in on the action too. That's exciting. But I imagine there are still some hurdles to overcome, right? Are there minimum investment amounts or other restrictions that might prevent some people from participating?
Yes, that's important to keep in mind. Private market investments typically have higher minimum investment thresholds compared to publicly traded stocks or mutual funds. You'll also need to be comfortable with longer lockup periods, meaning your money could be tied up for several years. And the complexity of these investments can be daunting for some individuals.
Right. It's not something to jump into lightly. It requires careful consideration and a clear understanding of your own financial goals and risk tolerance.
Absolutely. And that's where financial literacy comes in. It's crucial for individuals to educate themselves about the intricacies of private market investing before diving in headfirst.
I think you've hit on a really important point there. The world of finance in general can feel incredibly complex and intimidating, especially for those who aren't immersed in it daily. How can the average person develop the financial literacy needed to make informed decisions, not just about private markets, but about their overall financial well-being?
You're right. Financial literacy is essential. Fortunately, there are numerous resources available to help people enhance their understanding of financial concepts. Online courses, books, podcasts like this one, and even financial advisors can provide valuable guidance and education.
So it's about being proactive, seeking out information,
Yes.
and not being afraid to ask questions. But I imagine it's also about finding trustworthy sources of information, right? With so much financial noise out there, how do you cut through the clutter and identify credible experts and resources?
That's an excellent point. It's crucial to be discerning and critical when evaluating financial information. Look for sources with a proven track record, unbiased perspectives, and a focus on education rather than just selling products or services.
So it's about being a savvy consumer of financial information, which applies to private markets and beyond. Now, speaking of navigating this complex landscape, there's another key player we haven't talked about yet, regulators. How is the evolving regulatory environment shaping the future of private markets, and what does it mean for investors?
Regulation is a critical aspect of private markets, and it's something that's constantly evolving. Historically, private markets have been less regulated than public markets, partly because they involve more sophisticated investors and larger institutions.
That makes sense. If you're dealing with seasoned investors who presumably understand the risks, there's perhaps less need for heavy-handed regulation.
Right. But as private markets have become more mainstream and accessible to a wider range of investors, the calls for greater transparency and oversight have grown louder.
Which is understandable. If everyday people are putting their hard-earned money into these investments, they deserve the same level of protection and regulatory scrutiny as those investing in the public markets.
Exactly. And regulators around the world are responding to these calls for increased transparency. We're seeing new rules being proposed and implemented
Okay.
aimed at enhancing disclosure requirements, clarifying fee structures, and addressing potential conflicts of interest within the private market industry.
So it's like the Wild West of finance is slowly getting some sheriffs in town, which is probably a good thing for both investors and the overall health of the market.
That's a good analogy, but it's important to note that finding the right balance is crucial. Too much regulation could stifle innovation and make it more difficult for businesses to raise capital, particularly startups and smaller companies that rely heavily on private markets for funding.
So it's a delicate balancing act between protecting investors and fostering a dynamic and innovative market environment. What should our listeners be paying attention to as this regulatory landscape continues to evolve?
Well, first and foremost, stay informed. Be aware that the rules of the game are changing, and what was acceptable a few years ago might not be acceptable today. Different jurisdictions have different approaches to regulating private markets, so be sure to understand the specific rules and regulations that apply to the investments you're considering.
It sounds like staying on top of regulatory changes is crucial for anyone involved in private markets, and it reinforces the point we made earlier about the importance of financial literacy and doing your research.
Absolutely. And remember, seeking professional advice from a qualified financial advisor can also be invaluable, especially when navigating the complexities of private market investing and staying abreast of regulatory developments.
Okay, so we've covered a lot of ground today, exploring the forces driving the mainstreaming of private markets, the risks and opportunities they present, the importance of financial literacy, and the evolving regulatory landscape. But before we move on, there's another crucial element we need to address, one that often gets overlooked in discussions about finance, the human element.
Yes, we can talk all day about data, trends, regulations, and strategies. But at the end of the day, it's people who make financial decisions. And those decisions are influenced by a myriad of factors beyond just cold, hard numbers.
Exactly, we're not robots. Our emotions,
Yeah.
biases, and even our cultural backgrounds can play a significant role in how we approach money and investing. How do we account for that human element and make sure we're making rational, informed decisions, even when our brains might be working against us?
That's a fascinating and important question. Behavioral economics,
Hmm.
a field that combines psychology and economics, has shed light on how our cognitive biases can influence our financial decisions. Understanding these biases can help us make more informed choices.
So it's fascinating to think that our brains, which are incredibly powerful, can sometimes lead us astray when it comes to financial decisions. Could you share some examples of these cognitive biases and how they might affect our investment choices?
Absolutely. One common bias is confirmation bias, which is our tendency to favor information that confirms our pre-existing beliefs, while downplaying or ignoring contradictory evidence, for instance. If you're already convinced that private markets are a surefire path to riches, you might be more likely to focus on the success stories and ignore the inherent risks we've discussed.
So we might cherry pick information that supports our gut feeling, even if a more balanced perspective would lead to a different conclusion. That's a trap I can see many people falling into, myself included. Are there other biases we should be aware of?
Another powerful one is loss aversion. Studies have shown that the pain of losing money is psychologically twice as powerful as the pleasure of gaining the same amount. This can lead investors to be overly cautious or even avoid potentially profitable opportunities because they're fixated on the possibility of losses.
That makes sense. Fear of losing what we've already got can hold us back from taking calculated risks that could ultimately benefit us in the long run. It sounds like understanding these biases is crucial for making rational investment decisions, especially when venturing into something as complex as private markets.
Precisely. By being aware of these biases, we can start to make more objective decisions. Another helpful strategy is to seek out diverse perspectives and challenge our own assumptions. Don't just surround yourself with people who echo your own opinions. Talk to people who have different viewpoints and experiences, and be open to considering alternative approaches.
That's great advice for any aspect of life, not just investing. Now let's shift gears a bit and talk about the real-world impact of private markets. We've discussed the trends, the risks, and the human element. But how is all of this playing out on the ground? How are private markets affecting businesses, communities, and individuals in tangible ways?
One of the most exciting aspects of private markets is their ability to bridge the gap between Wall Street and Main Street. They're not just abstract financial instruments. They're having a direct impact on businesses and communities, particularly small businesses that have historically struggled to access traditional forms of financing.
That's an area I'm particularly interested in. Small businesses are the backbone of many economies, but they often face challenges securing loans from banks, especially in recent years. How are private markets providing alternative avenues for them to access capital?
Private markets offer a range of options for small businesses seeking funding. We've already touched on equity crowdfunding, which allows businesses to raise capital from a large pool of individual investors online. There's also the rise of online lenders who use technology to streamline the lending process and provide faster access to capital compared to traditional banks.
So instead of going through the often cumbersome process of applying for a bank loan, small business owners now have more flexible and potentially faster funding options. What kind of impact is this having on their ability to grow and create jobs?
The impact can be significant. Access to capital allows small businesses to expand their operations, invest in new equipment or technology, hire additional employees, and ultimately contribute more to their local economies. It's creating a ripple effect of positive economic activity, empowering entrepreneurs, and fostering innovation.
It sounds like private markets are democratizing access to capital, leveling the playing field for small businesses, and fostering a more vibrant and entrepreneurial ecosystem. It's not just about big corporations and Wall Street anymore.
Exactly. And the impact extends beyond just small businesses. We're seeing private capital flow into a wide range of sectors, from renewable energy and sustainable infrastructure to healthcare and education.
There's a growing trend towards impact investing, isn't there? Where investors are specifically seeking out companies or projects that align with their values and aim to generate positive social or environmental outcomes alongside financial returns.
Yes, impact investing is gaining momentum as more investors seek to make a difference with their capital. We're seeing investments in companies that are developing clean energy technologies, promoting sustainable agriculture, expanding access to affordable housing, and addressing a wide range of social challenges.
It's inspiring to see how private markets can be harnessed to drive positive change, creating a more sustainable and equitable future. But let's not forget about the individual investor. We talked earlier about how private markets are becoming more accessible, but how are individuals directly benefiting from this shift?
For individuals, the most direct benefit is the potential to diversify their portfolios beyond traditional investments and access potentially higher returns. Platforms like equity crowdfunding allow individuals to invest in startups and early-stage companies that have the potential for significant growth, something that was previously only available to accredited investors or venture capitalists.
So it's an opportunity for individuals to participate in the next big thing, to support innovative ideas, and potentially reap the rewards of their success. It sounds exciting, but we also need to acknowledge the risks involved, right?
Absolutely. It's crucial for individuals to remember that investing in private markets carries inherent risks, including illiquidity, volatility, and the potential for loss. Thorough due diligence, diversification, and a clear understanding of your own investment goals and risk tolerance are essential.
It's like anything else in life. There are no guaranteed returns, and it's crucial to weigh the potential rewards against the risks. As we wrap up this deep dive into the world of private markets, what's the key takeaway you want to leave our listeners with?
Private markets are transforming the financial landscape, creating both opportunities and challenges. The key is to approach this evolving world with a balanced perspective, a blend of curiosity, critical thinking, and a willingness to learn and adapt.
That's a great point. It's not about blindly jumping into the next hot investment. It's about staying informed, asking the right questions, and making thoughtful decisions that align with your individual goals and circumstances. I think that's a great note to end on. Thanks for joining us on this deep dive into the world of private markets. Until next time, keep exploring, keep learning, and keep diving.